There exists a peculiar paradox in the modern pursuit of wealth, a contradiction so common it has become invisible. Across the nation, individuals meticulously research stock picks and cryptocurrency trends while simultaneously allowing high-interest debt to silently devour their financial foundations. It resembles the ancient fable of filling a vessel riddled with holes, then wondering why prosperity remains elusive. The bucket empties as quickly as it fills, and the cycle perpetuates itself in quiet desperation. The statistics paint a sobering portrait of financial fragility. 1 in 3 Americans navigates life without an emergency fund, without that fundamental buffer between stability and chaos. The median emergency savings across the country stands at a mere $500, a sum insufficient to weather even modest storms. This figure represents a decline from $600 just 1 year prior, suggesting a troubling trajectory. $500, less than most monthly car payments, less than a single unexpected medical bill, less than the repair cost for a failing transmission. Yet these same individuals, standing on this precarious foundation, inquire about individual stock selections and cryptocurrency investments. They ask which assets will multiply their wealth, which trends to follow, which opportunities to seize. It mirrors the absurdity of debating luxury vehicle purchases while lacking the means to repair one's current automobile. The truth, though unglamorous, remains immutable. There exists an optimal sequence for deploying capital that can preserve tens of thousands of dollars over a lifetime and dramatically accelerate the journey toward financial independence. This sequence, however, lacks the seductive appeal of selecting the next revolutionary company or attempting to predict market movements. It requires embracing foundational work that feels tedious, methodical, and unglamorous, precisely the qualities that make it effective. Before exploring this sequence step by step, consider why disorder proves so devastating. Imagine constructing a dwelling. One would never begin by selecting ornate lighting fixtures and premium countertops while the foundation crumbles and the roof leaks. Yet this precisely describes how most people approach their finances. They pursue excitement, the latest trending investment vehicle, while carrying high-interest obligations guaranteed to obliterate any potential gains. The opportunity cost of missequencing these decisions compounds with frightening velocity. Each month spent servicing credit card debt at 22% interest represents a month where liabilities grow faster than virtually any reasonable investment return. Each month of ignoring an employer's matching contribution means abandoning free money. Each month of contributing to taxable accounts before maximizing tax-advantaged options means unnecessarily enriching the tax collector rather than oneself. Before deploying a single dollar toward investments, one must establish an emergency fund. This counsel sounds mundane, perhaps even tedious, compared to discussions of wealth-building strategies. Yet its importance transcends the obvious purpose of covering unexpected expenses. An emergency fund serves as psychological architecture, a mental fortress preventing catastrophic financial decisions when life inevitably delivers its surprises. When vehicles fail or medical emergencies arise, having reserves means avoiding two destructive outcomes: liquidating investments at inopportune moments or accumulating high-interest debt to bridge the gap. The perennial question arises: how much? Traditional guidance suggests 3 to 6 months of living expenses, but this range proves so broad as to border on meaningless. The appropriate amount depends on individual circumstances. Those with stable employment and robust benefits might adequately protect themselves with 3 months of expenses. Freelancers in volatile industries, lacking institutional safety nets, may require 6 months or more. A practical approach begins with accumulating the first $1,000 as rapidly as possible. This covers most minor emergencies and constructs that crucial psychological safety net. From there, one builds toward 1 month of expenses, then progresses toward 3 months. This methodology transforms an overwhelming objective into manageable milestones. Recent research from Vanguard revealed something fascinating. Individuals with at least $2,000 in emergency savings reported financial well-being scores 21% higher than those without any emergency fund. This represented the largest boost associated with any financial factor measured. $2,000 hardly qualifies as life-changing wealth, yet the psychological impact of possessing that buffer proves enormous. Once emergency reserves stand in place, the next step demands absolute priority, eliminating all high-interest debt before investing anything else. High-interest debt, anything exceeding approximately 8% annually, though this threshold fluctuates with market conditions, functions as financial cancer. Credit card debt stands as the obvious antagonist. With average interest rates surpassing 22%, credit card balances grow faster than virtually any reasonable investment return one could expect. Carrying such debt while simultaneously investing resembles attempting to run a marathon while bearing a backpack filled with stones. The mathematics prove unforgiving. Paying down debt with a guaranteed high interest rate provides a guaranteed return equal to that interest rate, often exceeding what one can reasonably expect from equity markets after taxes. Consider this perspective. $5,000 in credit card debt at 22% interest, serviced through minimum payments, generates nearly $2,800 in interest over 5 years. That represents capital that could have compounded for the borrower rather than the lender. Every dollar directed toward eliminating this debt essentially earns a guaranteed 22% return, superior to Warren Buffett's long-term average. The strategy for efficient debt elimination follows straightforward logic. List all obligations with their interest rates and minimum payments, service the minimums on everything, then direct every surplus dollar toward the debt with the highest interest rate. This debt avalanche method saves the most money mathematically, though some prefer the debt snowball method, eliminating smallest balances first for psychological momentum. Here the sequence reveals its first fascinating exception. If an employer offers matching contributions to retirement plans, one should contribute enough to secure the full match even before finishing high-interest debt elimination. This may seem counterintuitive, but the mathematics prove compelling. Employer matching essentially provides a guaranteed 100% return on investment up to the match limit. Even while carrying credit card debt at 22%, securing a 100% immediate return generally makes sense. It resembles discovering money lying on the ground that an employer will double merely for picking it up. Consider a typical example. An employer matches 50 cents on the dollar up to 6% of salary. For someone earning $50,000 annually, contributing $3,000 to receive the full $1,500 match represents a 50% immediate return, plus whatever the investments earn over time. No other investment opportunity can guarantee such returns. The strategy involves contributing just enough to secure the full match, then redirecting all surplus funds back toward eliminating high-interest debt. Once the debt disappears, retirement contributions can increase. This maximizes guaranteed returns while minimizing the duration of paying high interest rates. One caveat warrants consideration. Some companies implement vesting schedules determining how long one must remain with the company to retain matching funds. For those not planning extended tenure with their current employer, understanding the vesting schedule becomes crucial. However, even with vesting requirements, the immediate return from employer matching usually justifies participation. This foundation, emergency funds, debt elimination, and employer matching creates the bedrock of financial architecture. Without these pieces, everything else built atop them rests on quicksand. Once these foundational elements lock into place, one enters what might be called the tax optimization zone, where things become genuinely interesting. Most people catastrophically err here because they become distracted by appealing novelties and skip directly to taxable investment accounts when they should first maximize every tax-advantaged option available. The next step involves maximizing individual retirement account contributions before adding more money to employer 401k plans. The reason proves simple. IRAs provide far more control over investment choices and typically feature much lower fees than most employer plans. Corporate 401k plans notoriously offer limited menus of expensive mutual funds with management fees that devour returns like termites consuming wooden structures. With an IRA, one can invest in low-cost index funds and exchange-traded funds charging fees of merely a few basis points rather than the 1 to 2% fees common in many 401k plans. Over decades, these fee differences can cost tens of thousands of dollars, the difference between preserving one's wealth and slowly feeding it to fund managers. For $250.25, one can contribute up to $7,000 to an IRA, or $8,000 for those 50 or older. Once IRA contributions reach their maximum, then one returns to the employer's 401k and begins contributing beyond the match. Here the decision grows more complex, choosing between traditional and Roth versions of these accounts. This choice can literally save or cost thousands in taxes over a lifetime. The decision distills to a deceptively simple question with a complicated answer. Does one want to pay taxes now or later? Traditional accounts allow deducting contributions from current taxable income, but taxes apply when withdrawing money in retirement. Roth accounts require paying taxes up front, but then all retirement withdrawals emerge completely tax-free. The general principle works as follows. If currently in a high tax bracket and expecting to occupy a lower one in retirement, choose traditional accounts to claim the tax deduction now. If in a lower bracket currently, but expecting higher rates later, choose Roth accounts to pay the lower tax rate today. The challenge lies in predicting future tax rates, about as reliable as forecasting weather 3 months hence. Young people starting careers should probably favor Roth accounts because they likely occupy their lowest earning years, and tax brackets will probably only ascend from there. High earners hitting peak income years might benefit more from traditional accounts to reduce current tax burdens. When uncertain, splitting contributions between both types creates tax diversification and provides options in retirement. For those with access to health savings accounts, this represents where things become genuinely exciting. HSAs might constitute the most underutilized investment vehicle in America, a Swiss Army knife of tax-advantaged accounts offering not 1, not 2, but 3 distinct tax benefits. One receives a tax deduction for contributions, just like traditional IRAs. Money grows tax-free while invested, like any retirement account. And here lies the remarkable distinction. Withdrawals for qualified medical expenses emerge completely tax-free, even in retirement. It remains the only account providing tax benefits on contributions during growth and upon withdrawal. For 2025, one can contribute up to $4,300 with individual coverage or $8,550 for family coverage. The requirement involves having a high-deductible health plan, which doesn't suit everyone. For those young, healthy, and without significant medical expenses, HSAs can become among the most powerful retirement accounts available. The strategy that renders HSAs incredibly powerful involves paying current medical expenses out of pocket when affordable, allowing HSA money to remain invested in markets. One keeps all medical receipts because no time limit exists for reimbursing oneself for qualified expenses. One could pay for a doctor visit today, preserve the receipt, and reimburse oneself from the HSA 20 years hence, tax-free. After age 65, HSAs become even more flexible. One can withdraw money for any purpose, not just medical expenses, though income tax applies to non-medical withdrawals just like traditional IRAs. But medical expenses in retirement are essentially guaranteed, so possessing a reservoir of tax-free money specifically for healthcare costs resembles having a secret weapon against one of retirement's most significant financial risks. The mathematics on HSAs can prove stunning. Maximizing HSA contributions for 30 years while achieving 7% annual returns could yield over $400,000 in completely tax-free money available for medical expenses. Given that average couples retiring today will spend over $300,000 on healthcare throughout retirement, an HSA can essentially make those costs vanish from retirement budgets. Once HSA contributions reach their maximum, one returns and maximizes 401k contributions beyond the employer match. The 2025 contribution limit stands at $23,500 for most people, or $31,000 for those 50 or older. At this juncture, one operates at peak efficiency from a tax perspective. Between IRA, HSA, and 401k, one could potentially shelter over $35,000 annually from current taxation if under 50, or considerably more when eligible for catch-up contributions. This represents serious capital that compounds without annual taxation. Something surprising about this entire process deserves mention. Most people never progress beyond this point. Average Americans save approximately 6% of income, usually insufficient to maximize even employer matching and IRA contributions, let alone everything else. But those who can work through this entire sequence already position themselves in the top 5% of savers in America, establishing foundations for retirements most people can only imagine. The elegance of following this optimal sequence lies in how each step builds upon previous ones, creating financial architecture that strengthens over time. Emergency funds prevent derailment when life happens. Eliminating high-interest debt stops the hemorrhaging of money to interest payments. Maximizing employer matching provides guaranteed returns. Tax-advantaged accounts allow more money to compound without government interference. Only after working through all tax-advantaged options does one finally reach the step most people wish to start with: taxable investment accounts. And a very specific strategy exists for approaching this final step that distinguishes between building serious wealth and possessing a hobby that occasionally generates money. Taxable investment accounts represent the frontier of investing, where one can purchase individual stocks, trade options, speculate on cryptocurrency, or simply invest in index funds without contribution limits or withdrawal restrictions. This is also where most people make their largest mistakes because they believe having access to every investment under the sun automatically confers wisdom. The challenge with taxable accounts that proves so frustrating. People grow so excited about flexibility and unlimited contributions that they completely forget about tax drag. Every dividend payment faces taxation. Every profitable sale means the government wants their portion. It resembles running a race while someone continuously throws sand in one's shoes. One can still finish, but the journey becomes far more difficult than necessary. The tax efficiency of maintaining money in retirement accounts versus taxable accounts can prove staggering over time. Consider, Investing $10,000 annually for 30 years in a tax-advantaged account earning 7% yields approximately $944,000. In a taxable account, with identical returns but paying taxes on dividends and capital gains along the way, one might end with closer to $700,000. That represents nearly a $250,000 difference purely from tax drag. Yet taxable accounts become valuable once everything else reaches maximum. They offer complete flexibility. Need money for a house down payment in 5 years? No problem. Want to retire early before accessing retirement accounts? Taxable accounts provide the bridge funding required. Planning to leave money to heirs? Taxable accounts receive a step-up in basis at death, potentially eliminating capital gains taxes entirely. Here, then, lies the optimal sequence for investing money that most people completely ignore in their rush toward rapid wealth: emergency fund, high-interest debt elimination, employer match, IRA maximization, HSA contributions, 401k, maximization, and finally, taxable accounts. Following this sequence means building wealth while others still attempt to identify the next revolutionary company. One's future self will express gratitude for embracing the unglamorous fundamentals first. The journey toward financial independence resembles constructing a cathedral. It requires patience, proper sequencing, and respect for foundational principles. Those willing to embrace this discipline, to resist the seductive appeal of shortcuts, position themselves not merely for comfortable retirements, but for genuine financial sovereignty. The path lacks excitement, but it leads somewhere worth going.